Universal life. Universal life is sometimes called interest sensitive. Whole life, it just depends. It basically means the same thing. It just has two different names. It's one of those situations where two names mean the same thing. Universal life has a stated interest rate, which is what grows the cash value, and that is stated for 1 year at a time. Every year when the policy renews, the insurance company is going to look at the interest rate that their universal policy is paying you, and they're going to look and see what the prevailing interest rates are out in the marketplace, what are loan rates, what are interest rates at banks, things like that. So if the interest rates are higher now, they may offer you a higher interest rate for the next year. So they do change. If, say, interest rates have dropped, between the time you took this rate last year and now rates are lower, they're going to offer you a lower interest rate now. That's how it works. Now, universal policies now do have kind of a bottom. They have a minimum interest rate, for example, 1 to 2%. So if interest rates really dropped very, very low, at least your policy would make 1 or 2% interest, and your cash values would still be growing a little bit. So it's a little bit of protection for the insured. But the annual rate is literally reviewed and changed according to the rates at the time it comes up for renewal every year. So it's kind of unique. It is unique to universal life. The monies from the premium dollars, the excess money goes into the cash value, and the interest, that rate that they're applying for 1 year is used to grow that cash value. Out of those cash values, the company can take their expenses, the cost of, the covering the mortality charges and the overhead and things like that. And then you as the insured could take loans and or withdrawals from the cash value. So it's just a kind of a different structure. On the whole life policies, they also use an interest rate, but it's a fixed guaranteed interest rate that never changes. That's the big difference between whole life and interest sensitive. The interest rate changes every year on interest sensitive whole life or universal life. A form of universal life is sometimes referred to as flexible premium adjustable life. So the insured can skip a premium payment as long as there's more money in the cash value than what your premium payment is that's due right now. So let's say you have a cash value of $400 and your premium that is due is $100. Well, you've got more money than the premium amount, so you could literally say, I'm not going to physically write a check and hand it to the insurance company. I want you to just take my premium payment out of my cash value. You can do that. Again, these flexible policies can really meet the needs of a lot of people, especially people with varying income. So it's a good thing that they can do that. So the cash values, always have to be more, of course, than what you need to cover your premium. If not, you wouldn't be able to say, take it out of the cash values. But it is nice to have that flexibility. You literally can skip writing a check and just have them take it out of the cash value. Great feature of that flexible premium adjustable life insurance. Universal life insurance, option A or option B. First of all, universal life are the only policies that have option A or option B. So if you have a test question asking you about option A, option B, you just remember the answer has to be some type of universal life insurance policy. So that's a clue right there. Okay, so with option A, you get a level death benefit. You can see the chart shows that the death benefit, when you first start out in the early years, there's a certain amount of death benefit there and it is level, and then it reaches a point where the death benefit starts to go up as the cash value is growing. Because remember, you don't want the two to equal until age 100, because these are still permanent policies. They all go out to age 100. But if you look at option B, you have a decreasing from the beginning, usually starting out at less than what the death benefit would be on option A, but it increases gradually over time, and you can see the cash value grows, more slowly because of that. So it's just a difference of, how you want the policy to perform or what you want it to do. Typically, generally, the option A has a cheaper premium. Sometimes the option B can be quite expensive. So people often like the idea of this increasing death benefit, but then when they see the cost of the premium, they go back and take option A. But it's going to be totally whatever is going to work best for the client. So it's nice to have that flexibility.